So the top thing to consider about interest rates and how it affects your mortgage is that higher interest rates will translate to higher mortgage payment. So basically that will increase your overall interest you do pay over the life of your loan. So a lower interest rate saves you money both in the short term and the long term. In the sense you'll pay less on interest over the lifetime. And of course, since you can't really time the stock market, it's nearly impossible for you to time your home purchase to meet the best interest rates offered. The past 5 years have held some of the most affordable interest rates ever. So according to Freddie Mac and Fannie Mae, they do predict that home values will continue to increase over the next year. So it might be a hard time for a purchase without the best interest rates, but there are things you can do to get a lower interest rate. So for an example would be getting a 15-year fixed. Basically, a fixed mortgage is better for you because that way you can plan your monthly expenses around it. The lowest payment will be based off of a 30-year fixed. So sometimes if the 15-year payment is too high, I do recommend sticking with a 30-year fixed. That way you have the option to set aside extra payments towards your mortgage. Basically allows for you to pay off your principal balance faster. So that one would be the accelerated mortgage payoff schedule. So basically, instead of making your regular mortgage payment on the first of every month, you'll take that total payment, divide that in half, and then have that paid out every 2 weeks. So the way that works is by making it every 2 weeks, you do pay an extra full mortgage payment a year. So on a 30-year term, that shaves off quite a bit on your payoff schedule because you're looking at an extra 4 to 7 years, depending on whether you have a 30-year mortgage right now or if you have a 15-year. So if it accelerates your payoff, then you are saving thousands over the life of your loan just on that interest.